Stock options are a common part of compensation packages, but they can be confusing. Let us break down how they actually work. At their core, an option is simply a contract that gives you the right to buy or sell stock at a set price. The strike price is the magic number. It stays fixed regardless of how the actual stock price moves in the public market. You usually cannot use these immediately. You have to wait through a vesting schedule, which encourages employees to stay with the company. Buying actual shares makes you an owner right away, while options represent a potential future opportunity to purchase those shares. If the market price rises above your strike price, you can buy the stock at a discount and sell it for a profit. Always remember that options carry risk. If the company value does not grow, those contracts might end up having no financial value at all. Understanding your compensation is a vital part of financial literacy. Consult a tax professional for your specific situation. Thanks for watching.